Hello and welcome everyone. I hope all of you are doing good. A very warm good afternoon. My name is Harshmeet Singh and I am here welcome you on behalf of Narayana IAS Academy. In this session, as you know, we have been discussing the most important current affairs specifically from economics aimed at helping those who are aiming to write the prelims examination this year, that is May 25th, 2025. The entire aim of this series is to cover all the important current affairs that have happened in the past year or so, and we have divided it subject wise. As you know, we have classes running for economics, for Indian polity. Yesterday, we also started classes of environment ecology. Make sure that you stay tuned on this channel and take advantage of all of these classes that will be covering the entire syllabus one by one. If you are new here, I would request you to hit the subscribe button. You can invite your other friends as well to join these sessions and take help from these sessions so that they are able to take the best out of this and get their civil services preparation the kind of edge that it requires. Also, if you are one of those who is thinking that my planning is to give the examination that next year, that is 2026, or maybe beyond that, for you also, we have full 1 and 2 year courses on offer for you. For all of those who have still not started your preparation or who are just in the initial phases of your preparation, we have these programs, a 1 year and 2 year program that will cover the syllabus starting from the prelims examination to the mains examination till the stage of the interview. All the aspects of this exam will be taken care of, including adequate answer writing practice, test series, current affair classes, and everything else that you require. If you need any information about any of these courses that we are offering, feel free to check out the description of this video. When you go to a description, you will find a link of our website. Go to that website and you will see all the information that you require about all of our courses. If you have any other questions, we'll be happy to answer those. Please do let us know. The comment section is always open for you. Do let us know what you think in the comment section. What other kind of classes would you require? And we'll be happy to oblige. With that said, let's not waste any time further and let's see what are the topics that we'll be taking up today. Now, in the past few days, we have been taking up a lot of topics about banking because it has been a question, or this sector specifically gets asked time and time again. Various aspects about banking, any new regulations by the RBI, any new thing or any new law that has come out about banks in India. Now, the next topic that we'll take up is called Payment Infrastructure Development Fund Scheme. Now, what exactly is this scheme and who is running this scheme? The basic idea is, in the past few years or so, there has been a drastic change in how we pay in the shops or in the merchants where we buy some stuff from. Just go back a few years. When you went out of your house, it was unimaginable that you would not take your wallet or cash with you. It was unimaginable. If you go out of your house without the wallet, in 100% cases, you would come back and you would grab a wallet, you would grab some cash, put it in your pocket and then go, because you required that when you're out. Now, as long as you have your mobile phone with you, most people, including myself, I intentionally leave my wallet at home as long as I have my mobile phone with me, because I know wherever I go, in almost all the places, the payment will be accepted via UPI. I would not need my wallet, I would not need my cash. Now, the interesting part is this flourishing of QR codes or acceptance by UPI. It's an example of how, when the government and the private sector can come together, the amazing results that they can bring in. Because UPI is an invention of the government. UPI was invented by the government and they are making it freely available to be used by these apps like PhonePe, Google Pay, Paytm, etc. They can use the algorithm of UPI that is being made available by the government. On the other hand, the proliferation of these QR codes, the proliferation of these sound boxes at each and every shop that you see, that is not done by the government, that is done by the private sector. So while the private sector has made sure that there is availability of all these devices, the small sound boxes or your QR code, at each and every interval, means even if you go to a roadside vendor who is selling you something on the road, does not even have a permanent address, even with them you will find that QR code. That has been made possible because of this expansion of all this payment infrastructure. This is what the scheme is focusing on. The scheme that is being run here by the RBI, under this scheme, the intention is to spread payment infrastructure far and wide. The merchants that still do not have the option to accept online payment, be it in the form of a QR code, be it in the form of that POS machine, the point of sale machine, using which you can swipe your card. The intention of the RBI is to spread that far and wide, to give incentive for its usage, to reduce the cost. This is what the scheme is doing. The entire name of the scheme is Payment Infrastructure Development Fund Scheme. Again, it will try and reduce the cost of any merchant, of any of the retailers who are trying to use that POS machine, so that they can adopt this and they can also enter the world and take advantage of digital payment. The scheme is mainly run by RBI. It is an ongoing scheme, it's not new. The reason why it is in the news is that it has been extended for 2 years. So RBI has already been running this scheme. Now they are extending it even further, because there are many parts of the country which still have not been touched by this digital payment revolution. So that is why the RBI wants to include them as well, and that is why the scheme has now been extended. Now let's understand what the scheme is, since when has it been running, and what are the focus areas right now, means in which area specifically RBI is focusing on. Now it's not a new scheme, as I said. The reason why it is in the news is that it has been extended now for 2 more years. It has been running since Jan 2021. So kind of around the pandemic, it's somewhere between first and the second wave of pandemic that we had. So Jan 2021 is when the scheme was first rolled out. The idea is again to ensure that payment acceptance or digital payment acceptance is increased in the country. See, when a shopkeeper, a merchant accepts digital payment or wants to accept digital payment, there are 2 aspects of it. One aspect is the trust factor. Do the shopkeepers trust that someone who is transferring money to them via their mobile phone, do they trust that the money will come to their account or not? That is taken care of by UPI, because it's instant. When someone transfers the money, instantly you can see it in your account, it has been credited to your account. The second part is, even if someone trusts and wants to accept this option, the second point is, do you have the infrastructure to do that now? Means, do you have these machines, the POS machines, or do you have the availability of these QR codes, the sound boxes, etc.? Both of these components have to work together. While the trust factor is taken care of by the UPI, the RBI is trying to make sure that the infrastructure required for accepting payments is made available far and wide, without having to spend a lot of money from the side of the merchant. These are the key features. It aims to develop payment acceptance infrastructure, especially in tier 3 to tier 6 cities. Please understand this. In bigger cities, tier 1, even tier 2 cities, payment infrastructure has become much better now. As I said earlier, if you're in a big city, even if you go to the smallest of vendors, roadside vendors, you will see those QR codes available and you will be able to make payment via UPI. So tier 1, tier 2 are usually covered. The scheme is trying to open up tier 3 to tier 6 towns as well, specifically for this. The special focus of the scheme is on the unserved or underserved areas that are mainly in northeastern states, Jammu, Kashmir and Ladakh. That is the idea. Now, what exactly is the scheme about? What will they offer? They will offer subsidies. So they will cut down the initial cost that the merchant would have to pay for these point of sales machines, or POS machine as you call them. Remember yesterday we talked about POS, point of sales machines, when we were talking about payment aggregators, the RBI rules for payment aggregators. So the scheme offers subsidies to the banks and to the eligible entities for deploying the point of sale devices. Again, point of sale devices are those machines using which you swipe your card. So when you go to a merchant, you pay with a card. There is a machine in which they insert the card or they swipe the card, then you enter your PIN code and the money is deducted. That machine is called the POS. So when the merchant or when the company gives a point of sale machine to the merchant will not have to pay the full cost. The RBI will come in and they will give a certain kind of subsidy. Similarly, if QR codes are given, then also subsidy will be given. Now, how much subsidy are we talking about under the scheme? So the scheme says 30 to 50% subsidy for physical POS devices. So the swipe machines that you have, if the cost, let's say, is 5,000 rupees, 30 to 50% of that will be borne by the scheme, where money is coming in from RBI and some other entities. And for digital POS, means for QR code, etc. For example, whatever expense they would have, 50 to 75% of that would be given by the RBI. So RBI is basically trying to make sure that it is more affordable for the merchants to come and to accept these kind of payment system. Now, who is funding this? Where is the money coming from? Is it the RBI alone? No, not the RBI alone. Now understand this, when this kind of a scheme works, or for example, let's say when more and more merchants have that POS machine, who wins? Who is the one who gets the benefit out of it? RBI or the government? Obviously they do get the benefit out of it because the people are moving towards financial inclusion. But who is the other party who is getting benefit with more and more of these POS machines? These are the card companies, Visa, Mastercard. They are the companies whose cards will now be accepted even more. So they would earn more commission. So they would be happy to ensure that these kind of schemes become successful. That is why the money that will come in the scheme is not just from the side of the RBI. These card operators or these aggregators of payment, they will also contribute money. So it's funded by RBI and major authorized card networks in India. And again, when you say card networks, what we mean to say is Visa, Mastercard, RuPay. These are the card networks. If you have a credit or a debit card, just look at your credit or debit card. You will see on the corner, maybe most probably on the bottom corner, you will see the name either Visa or Mastercard or RuPay. That is a card network. So they will also be funding. They will also be putting the funds in this scheme. It is governed by Advisory Council and administered by the RBI. Along with RBI, again, there are other organizations also that will be looking into the working of this, like the Indian Banks Association, Payment Council of India. All of that will make sure the scheme gets implemented properly. Now, it's not a new scheme. I'm repeating this once again. It is a scheme that is in the news because it has been extended for 2 more years. So it has been running already, and the result is, since 2021, the scheme that has been running, the result is that over 2.5 lakh, 2.5 lakh digital POS devices have been deployed under the scheme. So it is a good outcome. Over 2.5 lakh merchants that may not have had the POS devices earlier, they now have POS devices. We have a situation where people who are willing to pay or who are buying something from that shop have a flexibility to pay with more options. Now, because the scheme has been expanded recently, there are some other inclusions that have been in this scheme. For example, one, PM Vishwakarma scheme has also been added, have also been added up as a part of the scheme. What is PM Vishwakarma? So PM Vishwakarma is a scheme under which the government is trying to give help to people who do a lot of craftsmanship. So people who do manual work, or people who are, let's say, craftsmanship such as, let's say, cobbler, plumber, those kind of people, they are benefited under PM Vishwakarma scheme. So those individuals who are taking benefit under PM Vishwakarma scheme, where the government is helping them with giving them more training, giving them more knowledge about their own job, they will also be helped under this scheme. They will also be given the POS or the QR code at a subsidized price. Now, what are the devices that are eligible? Means when the subsidy is given, it has to be on certain kind of devices. This is specifically written in this scheme. Eligible devices, for example, will be sound box. Sound box means, you know, when you pay on any shop now, as soon as the payment is made, there's a sound that comes in that the merchant has received rupees 300, the merchant has received rupees 100, whatever you pay, that's an audio confirmation that they have. That's called a sound box. PhonePe, Paytm, for example, all of them have their own sound boxes. So if a sound box is installed, that will also be given subsidy. Aadhaar enabled biometric devices like Bheem, Aadhaar Pay, etc., they are also eligible for subsidy. So all these devices, if they are installed at the merchant, they will be given subsidy under this particular scheme. Also in the special focus areas, means in the areas which are underserved or which are unserved, means they either do not have a lot of these devices or they have very few of these devices, then they would be given even more subsidy. What are these areas? The special focus areas under this are the northeastern states, Union Territory Jammu and Kashmir and Ladakh. For this specifically, the subsidy has been increased even more. So the subsidy will focus specifically on those areas that do not have as much coverage of these kind of payment infrastructure, as is the case in some other parts of the country, to achieve the purpose of this scheme. I hope you understood that. I hope you got that. If you did, let's see if you can answer this particular question. Read it carefully. Read it carefully and try and make up your mind what should be the answer here. Done? If you still need more time, you can pause on this screen and then you can think about the answer. Till then, let's discuss. With reference to the Payment Infrastructure Development Fund scheme of the Reserve Bank of India, consider the following statements. Number one, the PIDF scheme aims to subsidize the deployment of credit acceptance infrastructure with a focus on tier 3 to tier 6 centers and northeastern states. Exactly what we discussed. This is the aim of this scheme, that tier 3 to tier 6, so small towns, villages, that will be the focus where payment infrastructure has still not reached. That is the center of focus for this particular scheme. The scheme was extended till December 31st, 2025 and includes beneficiaries of PM Vishwakarma scheme as eligible merchants. Something that we did discuss, the PM Vishwakarma scheme, that is benefiting those artists, those let's say people who do skilled labor. They are also part of the scheme. They will also be given this payment infrastructure so that they can accept payments easily. The corpus of PIDF is funded solely by RBI with no contribution from card issuing banks or card networks. I just discussed this a few minutes back. RBI alone is not giving the money. Along with RBI, the card networks, the major card networks operating in India are also contributing to this because they also would be at a position of advantage if this scheme becomes successful. As of August 2023, the scheme has facilitated deployment of over 2.66 crore new payment touchpoints across country. That is actually true. It's a huge number, but this scheme has been able to achieve it. Because of it, the expansion of payment infrastructure has picked up pace, considerable pace in India. Over 2.66 crore new payment touchpoint means new payment infrastructure systems have been set up here. 1, 2 and 4 is correct, are correct rather. The answer thus is A. So A is the answer here. I hope all of you got this right. This is the explanation part. If you want, you can take a screenshot here as well. It will be helpful for your revision later on. Got it? All right. I have one more question. Let's see if you can answer this. Again, read this carefully and make up your mind. Think about what the answer should be. Read this carefully and decide what the answer should be here. Again, before you make up your mind, I'll remind you once again, as I did yesterday as well, they're asking you which of these is not correct. So before you decide in your mind what should be the right answer, you have to tell which of these is not correct, okay? Got it? Okay. Let's see then. First, consider the following statements regarding Payment Infrastructure Development Fund scheme and its implementation. First statement, the PIDF scheme offers subsidy of 30% to 50% for physical point of sale devices and 50% to 75% for digital POS devices. That is what we discussed. So there are different subsidies given depending upon what kind of device actually are you deploying, because the cost will also be different. So the RBI then, according to that, depending on that, decides how much subsidy would you be given under the program. So it's different. The subsidy proportion is higher in case of digital devices and lower in case of physical devices. Second, Advisory Council for PIDF is chaired by the Governor of RBI. Now, is that correct? That's a tricky one. Is the RBI governor heading the council that is looking into implementation of it? No. It is actually the deputy governor. It is a deputy governor of the RBI that will be heading this committee. It's not the governor. So deputy governor looks into it. Third, the scheme includes Aadhaar-enabled biometric devices and soundbox devices as eligible for subsidies since 2023. Yes, we did discuss this. It covers a wide range of devices, which includes sound boxes and Aadhaar-enabled biometric devices as well. Next, The Economic Survey 24-25 credits PIDF scheme with achieving a 25% increase in digital transaction volumes in Tier 3 to Tier 6 entities or centers. Is it? No. So, the Economic Survey, and I've discussed this earlier as well, in most of the cases, it does not give a number about how much penetration has happened or whether this scheme has resulted in this much increase in credit, whether the Economic Survey, while it talks about the fact that this scheme has been helpful in improving payment infrastructure, but it does not give this number that payments have improved by this number because of this. That part is wrong. Since you had to choose the incorrect ones, 2 and 4 are incorrect. The answer here would be A. A is the correct answer here. 2 and 4 here are wrong. I hope you got this one right. Second one was slightly tricky, but do remember this part as well. If you want, you can take a screenshot from here as well. It will be helpful for your revision later on if you wish to. I'll move on to a related previous year question. Let's see if you can answer that. This was a question asked in 2017. Think about this. Think and then make up your mind. All right. Consider the following statements. Number 1. The National Payments Corporation of India helps in promoting the financial inclusion in the country. Does it? Yes. How? Because they are the inventors of UPI, and there is nothing that has done more for financial inclusion in the country than, on one hand, Jan Dhan accounts, and on the other hand, the payment ecosystem, the UPI. The thing that it has done, it has revolutionized online payment. As I said earlier, you could not imagine walking out of your house without a wallet, without some cash. Now you can because of this. NPCI has launched RuPay card payments scheme. Yes, the RuPay cards that are now being given. Earlier, we only used to have Visa and Mastercard as a 2 card issuing entities. Now we have RuPay as well. That is a product of NPCI. Both of these are correct. Answer here would be C. Very simple, straightforward. It was a straightforward question asked in Prelims 2017. Not a difficult one. I hope you got this one right as well. Questions similar to this scheme, the one that we have discussed, can very easily be asked in the prelims examination as well. All right then. Moving on to the second topic that we have here for the day. The second topic that we have here is revised priority sector lending norms, or priority sector lending anyways. Now, what exactly is priority sector lending? How does it work? Why is it so important? Please understand, priority sector lending, or PSL, is an extremely important component of how the government ensures that most sections that are a priority for the government get enough loans. Imagine this. When the banks give out loans, it is much more lucrative for them to give out loans to those entities which are taking huge amount of money, which will give them good interest rates. But the banks, in most cases, will not give out loans to those who are asking for smaller amount of loans, where the paperwork would be too complex, where they would not earn a lot of interest. So a lot of areas remain underserved. Let's, for example, talk about farm loans or agricultural loans. So the reason why now in India farm loans, or not even farm loan, education loan, the reason why now getting a farm loan or an education loan in India is much easier than what it used to be a few years back is because of something called priority sector lending. Now, what exactly is this? The simple idea is the banks are told that out of all the loans that you give, a specific portion of it, minimum this much, you have to give to certain areas which are called as priority areas by the government. Now, priority areas, for example, are farming or agriculture, affordable housing, education loan, whichever sector where the government wants credit to go, whichever sector where the government thinks that this is now a priority sector for us and we have to ensure that credit comes here, those sectors are listed in the priority sector. And the banks are told that you must give a portion of your loans to these sectors. For example, in case of scheduled commercial banks, 40% of the loans have to be given the priority sector lending area. For example, let's say SBI in the entire year gives out loans of 1,000 crore rupees. Okay, out of the 1,000 crore loans that the SBI has given, at least 400 crore has to go to these specific areas which are called the priority sector areas of the government. Please understand, RBI or the government is not telling them that you should give them free loans or you should give them loan at a lower rate of interest. No. The rate of interest of the loan is to be decided by the bank itself. There is no interference in that matter. The idea here is that they should give at least this much loan so that there is no shortage of credit. In fact, in Indian polity, I'm sure, or in post-independence history also, all of you, I'm sure, would have heard or would have read about bank nationalization under the Indira Gandhi government. When Indira Gandhi government was in power, what they did was they nationalized the banks. Nationalized the banks as in there were about 20 private banks in India, and the government announced that 14 of them are being taken over by the government. That very famously became the issue of bank nationalization. Now, why did the government nationalize the banks? Why did they take over the banks? The argument of the government was that these private banks are not giving loans to those areas or to those people who should get loan for the benefit of the country, because of which we are stepping in, we are taking over the banks, and the result will be that now we will decide whether the loans will be given to these sectors or not. After that, a few years later, priority sector lending came into picture, where the government said, okay, we will not take over the banks, but we will tell you which are the areas where you will have to give these loans. Now, you might also have this question that what if the bank does not give loans, or what if the bank does or is not able to comply with it? So there are two options. When the banks are not able to comply with this, for example, let's say, as I said, SBI had to give 100 crore or had to give 400 crore of priority sector loans, but they could not. People could not, or people did not come to ask for it. So the shortfall, if the shortfall of SBI is consistent, they consistently are not able to fulfill that requirement, the result will be that number one, they would or they might be punished or they might be penalized by the RBI. Secondly, whatever shortfall they have, that money will then be given to institutions such as NABARD. That will give agriculture loans later on, and that money will come back to bank, but after many years. So the banks usually try and fulfill their priority sector lending norm. Now, the reason why it is in the news is some of the priority sector lending norms have changed. Why? Because again, the government and the RBI want certain areas to get more credit. So the idea is that these guidelines have been revised to promote small loans in economically weaker districts specifically with a low average loan size. So those districts where the average loan size means the average loan that the person takes is anyways lower, in those districts specifically, they want more credit to flow. And this is where the priority sector lending norms have been revised. Now, let's first understand the priority sector lending. As I told you earlier, these are set of areas or sectors where the banks are encouraged to pay more loans or to give more loans. How? They are put certain conditions, and they're different for different banks. Usually for scheduled commercial banks, it is 40%. 40% of your loans have to give to priority sector areas. Now, what are these areas? These are some of the areas that are under priority sector. Agriculture is a priority sector area. MSME, that is micro, small, medium enterprises. Export credit, education, housing, social infrastructure, renewable energy. All of these come in the category of what you call as priority sector areas. So these are the areas in which if the SBI gives a loan, that will be counted as a priority sector loan or a priority sector lending loan. This is where the SBI or the banks can actually tell the RBI that, see, we have given this much money here, so that should be counted as a priority sector lending. As I said earlier, 40% is the limit, and that limit, how much the limit will be, is decided by RBI. That is the minimum limit. Obviously, the banks want, they can give more loans to these areas, but 40% is the minimum in these sectors for scheduled commercial bank. Now, what are the revised guidelines? Let's see. So, in most of the cases, the guidelines have enhanced the loan limit. For example, education loan. So, please understand, education loan also are of different types. If let's assume that you are going to Harvard or Cambridge to study, that is a very expensive course. If you go to Harvard to study, for example, you apply for a loan of 1 crore rupees. That will not be under priority sector lending. Please understand. So when you say education loan is under priority sector lending, that does not mean that all kind of education loans will be under priority sector lending. So up till a certain limit, the education loans will be under priority sector lending. So what is that limit now? As per the revised guidelines, that limit, for example, is up to 25 lakh for individual. So if an education loan is above 25 lakh, that is not called a priority sector lending loan. That's a normal loan, so that will not be counted here. So any loan up to 25 lakh, it also includes vocational courses. Now what are vocational courses? See, usually one of the courses that you have is you go to a college, you go to university, you earn a degree in return. So those are degree courses where you have a degree to show, a certificate to show. Then there are courses where you don't get a degree, you just learn a new skill. You go there to learn a new skill, maybe it will help you get a job, but you don't get a degree in return. Those are called vocational courses. Earlier, vocational courses in most of the banks were not eligible for any of the loans. The banks would say that no, if you don't get a degree, you will not get a job. If you don't get a job, we will not get our money back, so we will not give you loans for vocational courses. Now, vocational courses are also covered under this. Apart from that, social infrastructure, for that also there is a limit, up to 8 crore per borrower for setting up schools, drinking water facility, etc. So social infrastructure loans are priority sector lending, but again up to a limit of 8 crore per borrower. If the borrower is taking loan for building social infrastructure, school, hospitals, drinking water facility, only up to 8 crore, that is priority sector lending. Other housing loan limits, etc., have also been increased slightly in order to focus on priority sector lending. Apart from that, renewable energy, which is again one of the focus areas of the government. As you know, the government wants to improve and increase our capacity for solar energy or wind energy. So for that also up to 35 crore of renewable energy based power generators, that will also be considered as a priority sector lending. Also for an individual, a lot of individuals, for example, are now installing solar power plants in their own households. So if you have a, let's say, terrace, on your terrace if you want to, let's say, put solar panels to generate your own electricity, you can. There are many companies that will do this for you. So if an individual takes a loan for generating renewable energy, up to 10 lakh will be again under priority sector lending. Now, apart from this, one other interesting change that has happened, as I've been telling you, 40% is the limit that RBI puts, the minimum limit, but that is for scheduled commercial banks, not for all the banks. There are certain banks who have to give even more loan in the form of priority sector lending. For example, look at the urban cooperative banks. For urban cooperative banks, the limit is minimum 60% should be in priority sector lending, out of which micro enterprises should get 7.5%, weaker section should get 12%. So for urban cooperative banks, the limit is even higher. The minimum limit, they have to give even more loan in the form of priority sector lending areas. This is the category of weaker section. So when the government says, or when the bank says that priority sector lending also include loan to weaker sections, these are the weaker sections that we are talking about. So basically now weaker sections include transgenders as well. That's a very, very, very important revision. Do remember this. Small and marginal farmers, distressed families, indebted to non-institutional lenders, etc. Those are earlier also a part of weaker section. Now transgenders have also been included here. Also individual women beneficiary up to 2 lakh loan, they also would come under the weaker section. So the loans given to weaker sections are considered as priority sector lending. For that purpose, this is the weaker section that we are talking about. These kind of details are important. They are asked in the paper. And again, this also includes transgenders now, which was not the case earlier. These are the usual sectors that are under priority sector lending. I told you earlier as well. Agriculture, MSME, education. This is the weaker section one that I was talking about. Loans given to weaker section. Weaker section includes who? That was the definition that we just saw. Renewable energy, social infrastructure like hospital, schools, drinking water facility to be built, money given in these areas up till a certain limit. For education, for example, that limit is 25 lakh. So loans given in these areas up till a certain limit are considered as priority sector lending. Otherwise, they are called as just common loans. This is, for example, how the banks, have to fulfill the priority sector lending norm. So for scheduled commercial banks, for example, are the ones that have like SBI, HDFC, ICICI, PNB, etc. their priority sector lending in total has to be 40% at least. Foreign banks in India with branches less than 20 branches, again 40%. Regional rural banks that mainly operate in the rural areas, 75%. For small finance banks, again 75%. This is the total target, the total minimum target that they have to fulfill. This is the amount of loans that they give out have to be in priority sector lending. Then there is sub-categorization in certain cases. For example, in scheduled commercial banks, 18% of this has to be in agriculture, 7.5% has to be in micro enterprises. Weaker section must get 12%. So there is a categorization as well, and then the remaining one they can use wherever they want. But there is a sub-categorization that has also been important. Again, all these are in minimum. All this is the minimum limit. That at least this much has to be given in these areas. If the banks are willing to give even more than that, well and good, it's up to them. But this is the minimum that the banks have to give. Similarly, regional rural banks, etc., and small finance banks, all of these have been given these targets and sub-targets by the RBI. They will decide how much do they have to give, but minimum this much. And I told you earlier as well, what if they don't? Then the outcome is, if they are doing it year on year, so if there is a bank that is very regularly missing its priority sector lending norms, then the RBI has a right to put some fine, to take some action against them. Also, whatever shortfall they have, if for example a bank, as per the calculation, had to give 500 crore loan in the priority sector area but could only give 200 crore, the remaining 300 crore will be given to NABARD in most cases, in some cases SIDBI. That will be given to them, and they will then give out agriculture loans or small industry loan depending upon whatever their clientele is. The banks will get the money back, but these are very long-term loans. So no bank ideally would want their money to go to NABARD or SIDBI, because not that they don't get the money back, they do, but then those become very long tenure loans. So in those cases of long tenure loans, we don't have the money, the banks don't have the money coming back quickly enough. So they do not really appreciate it. Now, if you look at how priority sector lending has come up, how priority sector lending has actually evolved in India, it goes way back to 1960s. It was in 1969 that we famously had the Gadgil committee that proposed something called area approach. Again, area approach was that in certain areas or certain sectors, more credit flow has to be ensured. So more loans should be given in certain areas. That is what the area approach was. Nariman Committee in 1969 again supported this idea, and they recommended that public sector banks especially should have certain districts as lead banks. Means, for example, PNB is told that this district, in this district you are the lead bank, so you have to give most of the loans in this district. SBI is told that this is the district where you are the lead bank, so you have to give most of the loans. So the government banks were kind of made responsible to ensure that the credit flow within the district remains healthy, and that is your responsibility. Then formally, PSL became a part of the Indian banking system in 1972. Do you remember this? It was based on RBI's informal study group's report. Initially, there were no targets set. Then the banks were advised to raise it to 33.3% in 1979. The 40% limit that we see being operational right now started in 1980 with the Krishnaswamy Committee, 1980 recommending there should be a 40% target, and then after that many other committees have been coming up, but 40% remains the limit as we discussed in the scheduled commercial banks. So there are different banks with different limits, but scheduled commercial banks have seen this limit existing for a long time now. This is how the priority sector lending norms have evolved over the decades across the country. Whew. I hope you got this information in your mind. If you did, let's try it out. Let's see if you are able to answer this particular question. Read it carefully and see if you are able to answer this. If you have read this, great. If you still need more time, feel free to pause on this screen and then make up your mind to what the answer should be. With reference to revised priority sector lending norms effective from April 1st, 2025, consider the following statements. Number one, the revised norms increase the housing loan limit for PSL classification to rupees 50 lakh in cities with a population of 50 lakh or above. So mainly in those cities which have a population of over 50 lakh, in those cities up to 50 lakh of home loan will be considered as a priority sector lending. That is correct. This is a part of priority sector lending. Again, as I told you, when the government says housing loans are priority sector lending, they can't say all the housing loans. They have to put certain limits. So the government's focus is on affordable housing. So it depends on the definition of the government. What do they consider as affordable housing? Like in a city, let's say such as Bangalore, affordable housing will be very different from a tier 2, tier 3 city. As compared to a village, it will be very different. So affordable housing, the definition depends a lot upon which area you're talking about. That is why you have to categorize it. So first is correct. Second, urban cooperative banks are now required to allocate 60% of their adjusted net bank credit to priority sectors. We discussed this. This is correct. The 60% limit is especially for the urban cooperative banks. For scheduled commercial banks, it is 40. For let's say small finance banks, this is 75, so it's different. Loan for renewable energy projects up to 35 crore are eligible for PSL classification, except for individual households where the limit is 10 lakh. We discussed this also. If as an individual, you go and ask for a loan, for example, to put up a solar panel at your rooftop, it will be a PSL if the loan is up to 10 lakh. But if it's a larger loan by a company, etc., for the similar purpose, up to 35 crore, it will be under PSL. The norms mandate 125% weightage for new PSL loans in districts with per capita credit flow above 42,000. Now imagine this, when the government or the RBI is saying that in certain districts the PSL flow should be higher, means in certain districts PSL loans should be given more freely. What districts would they choose? Would they choose the poor districts where the flow is lower, or would they choose the rich districts? They would obviously choose the poor districts. That is wrong. Credit flow has to be below a certain level, not above 42,000. The average credit flow means a per person loan is 42,000, for example, in certain districts. Above that, you have to give more loans to them. Doesn't make sense. So the districts that have a low credit flow, the district where the credit or the loans that are given out are lower than usual, they are the ones where PSL norms should be followed more strictly. So fourth is wrong. 1, 2 and 3 are correct. The answer here becomes A. A is the correct answer. First 3 are correct, because again, just logically speaking, even if you don't know this number, just forget about this, but just think about this statement. When the government wants to intensify and push the banks that you have to give more loans in these districts, they would choose the districts where originally the loans that were given were lower, not higher. So 1, 2 and 3 are correct. A would be the correct answer in this case. If you want, you can take a screenshot from here. That will be helpful for you. Done? All right then. Let's look at one more question here. Let's see if we can answer this one. Again, based on the similar topic, priority sector lending. Think about the answer, and again you have to choose which of these is not correct. Think about the answer. If you know the answer, you can tell me in the chat as well. Let's see if you can get the answer right here. Read this carefully. Done? All right. If you need more time, feel free to pause on this screen maybe and then think about it. Consider the following statements regarding revised priority sector lending norms and their implications. First, The norms prohibit the banks from charging loan-related service fees on PSL loans up to 50,000 to protect the small borrowers. Now, what does it mean? See, when you take a loan from the bank, they do charge you some amount, some fees as well, like documentation fees, verification fee, this and that. So, if you take a loan, you have to give a fees as well. But the RBI says that if the loan that you are giving is a priority sector loan up to 50,000 only, means it's a small loan, you cannot charge any fee for it. That is correct. For up to 50,000 rupees priority sector lending loans, because they are taken by small borrowers, you cannot charge a fee separately on them. Loans against gold jewelry from NBFCs are now eligible for PSL classification to boost agricultural credit. No. Loan against gold is not under PSL. See, the idea of PSL is that you have to help poor people who usually do not get access to credit. If you are saying that people who have gold, they will be the one who can take loan and that will be PSL, no, that doesn't seem any logical. Second is wrong. Third, the revised norms expand weaker section category by removing the cap on loans to individual women beneficiaries by UCBs, that is the urban cooperative banks. Right or wrong? That is also correct. For urban cooperative banks, again, there is no limit of the loan taken by women. That will be called, and in the weaker section category, for example, the loan given to individual women will be called as priority sector lending only without any limit. Fourth, as per Economic Survey 24-25, revised PSL norms are projected to double the credit flow to MSMEs by 2030. No such report or data has come in from Economic Survey. They have not said that because of this credit will increase or something like that will happen. There is no projection like that. Thus, since you had to choose the incorrect ones, which of these is not correct, it is 2 and 4 which are incorrect. The answer thus is A. So, A is the answer. 2 and 4 here are incorrect. 1 and 3 are correct. A would be the answer in this case. Again, if you wish, you can take a screenshot from here. It will be helpful for your revision purpose. Got it? All right. I have a related previous year question for you. As you can see, a very straightforward, pretty simple question about PSL norms has been asked. It was asked in 2013. Priority sector lending by banks in India constitutes the lending to agriculture, micro and small enterprises, weaker section, or all of the above. The answer, as we all know, would be all of the above. All of these three are a part of the priority sector lending. Apart from that, social infrastructure, renewable energy projects, all that also is a part of priority sector lending. I showed you the list as well. All these will come under priority sector lending. So, D is the answer here. I don't think anyone would have a confusion in that. Pretty simple, straightforward one. Got it? Perfect. Let's move to the next topic then. The next topic that we have here is something called universal bank. Now, universal bank is not a new type of a bank. These are just normal banks that you see, the big banks like the SBI, HDFC, ICICI, PNB, Bank of Baroda, all these are universal banks. The idea of universal banks is that these are common banks, because apart from that, we also have something called differentiated banks. In the past few years, we also have had differentiated banks. Differentiated banks are the ones that focus on specific people, that focus on the specific sector. Like if you remember, yesterday we discussed about the payment banks. Today we will discuss about small finance banks, then urban cooperative banks. So when they focus on specific areas, specific sectors, specific clientele, then they are considered as differentiated banks. But the banks that are open for everyone, that do not distinguish between the customer base, do not distinguish between the sectors, they consider everyone equally. They have all the services that a usual bank will offer, the loans, the credit card, the saving accounts, everything that you can expect from a bank. Those are called as universal banks, similar. So, universal banks again are the common banks that you see around you, the big ones, not something that is unique. Why is it in the news? Because one of the small finance banks in India, that is the Ujjivan Small Finance Bank, has applied for a license from the RBI to convert itself into a universal bank now. If you were in the class yesterday, You would remember we discussed about the payment banks in India. And we discussed that payment banks can't give any loan or credit card, because of which the earning potential of a payment bank is very limited. Because for a bank, most of their money, most of their revenue comes in when they give out loan. Because they can't give out loan, they can't earn more money. And I told you the reason why many companies still opened up a payment bank, or why they applied for a payment bank license, is on the hope that let's start with this, after a few years we will ask RBI to convert us into a common or universal bank. This is what is happening here. So Jeevan Bank started as a small finance bank. Now it is hoping, it is trying its luck, it is asking the RBI, please let us get converted into a universal bank. That is why it is in the news. Now, please understand a few things here. If you go back earlier, a few years back, RBI would open up a window. For example, RBI would announce that from today onwards, we are open to giving licenses to banks. So everyone who wanted to get a license of the bank would apply. If they fulfill the qualification, if the RBI was happy with their credentials, they would give them the bank license. But now the system is you can apply whenever you want. There is no specific time, there is no specific window where the RBI would announce that now I am giving you the bank license. No. Now the system is any day. Today, if you want to apply to get a bank license, you can do that. There is no limit or there is no window that will be opened by the RBI specifically for this licensing. This is why Ujjivan Bank also has now said that we are applying for this license, and let's see if they will get it or not. Now, as I said, universal banks are the common big banks, the commercial banks that you see around you. The simple argument is that they are eligible to give out all the services that you expect to be given from a bank side. Demand deposit, time deposit, giving out loan, giving credit cards, helping with payment transfer, whatever you expect from a common bank, they will give you all these services, and that is why they are called as universal banks. Now, RBI, as I said, started something called one-tap licensing. This is the model I was talking about, that earlier RBI would specifically ask that now we are open to giving licenses for the next 6 months, so whoever wants can apply. But now that system is gone. Now anyone is open to apply whenever they want, they can apply, and RBI will then see whether, depending upon your application, whether you're worthy enough, you have a track record, you have enough money or not, what is your intention. On all those bases, RBI will decide whether to give you the bank license or not. This entire system is now called as one-tap licensing. So again, one-tap licensing means you can apply for a banking license at any point of time throughout the year, do not have to wait for one specific window. Now, what exactly are the eligibility criteria that the RBI has set for small finance banks if they want to transition into universal banks? See, for small finance banks also, although they can give out loans and everything, they do not have as much earning potential as, let's say, a universal bank would have. Like the small finance bank, for example, can give out loan, but 75% of the loans have to be in priority sector lending areas. Then small finance banks, because the name is small, they cannot take a lot of deposits from their customers. Like the deposit that they can take from the customer again is limited to 2 lakh per customer. Even if the customer has more money, wants to give more money, they still can't do that. So there is still a lot of limits on what a small finance bank can do. The limits are even more on payment bank, but small finance bank also has those limits. And because of this, they would want to transition. So RBI has given some eligibility norms that if you're a small finance bank and you fulfill these qualifications, you can apply for transition to a universal bank. We will look into it and we will see if you are eligible or not. So what is the eligibility criteria? First, the small finance banks that we are talking about here should have a net worth of at least 1,000 crore. It's not a small number, it's a pretty significant number. This should be a net worth. If you remember yesterday when we were discussing about payment banks, in order to open a payment bank, when you apply for payment bank, your minimum paid up capital was 100 crore. Here, your worth should be at least 1,000 crore. They must be a scheduled bank with a satisfactory track record of performance in the minimum 5 years. Now, what do you mean by satisfactory track record? This is very discretionary, because RBI decides what is satisfactory track record and what is not. I'll give you an example. We have been talking about PSL norms, the priority sector lending. Now imagine that situation. A small finance bank has to give 75% of their loan in priority sector lending. Now imagine there's a small finance bank who is missing that target year on year on year. If they are continuously missing that target, that means their track record is not satisfactory. This is where RBI will take into consideration all these factors. Whether you have a satisfactory track record or not, whether you have a track record that is something that where the RBI indication or wherever the RBI actually gave you certain guidelines, whether you fulfill them or not. The financial health as in, are you profitable or not? The bank should have a net profit in the last 2 financial years. How much profit? They are not explained explicitly arguing, but they just say that it should be profitable in the last 2 financial years. Asset quality, the gross NPAs and the net NPAs must be less than 3% and 1%. So gross NPA less than 3%, net NPA less than 1% over the last 2 financial years. Now, if you are someone who is confused, what do you mean by gross NPA? What do you mean by net NPA? Why is it that gross NPA is high and net is lower? Don't worry, I am here to tell you. A couple of days back, we discussed about NPAs, non-performing asset. Non-performing asset or NPA is the loan that the bank has given where the bank has not received any payment back for 90 days. So if for continuously 90 days, no money is coming back from a loan, that becomes an NPA, non-performing asset. Now, let's understand what is a gross NPA, what is net NPA. So let's imagine a situation where a bank has given a loan of 100 crore rupees, okay? The person started to pay the loan back. They were able to pay 20 crore back. It was paid back. But after that, the loan did not come back. After that, the person stopped paying. Now, in such a situation, what will be the gross NPA? Gross NPA will be the loan that you had given. So, in this example, gross NPA will be 100 crore. Because this was a loan that you had given and this has gone bad. But net NPA will be 100 crore minus whatever you have recovered. Because see, out of this 20 you have recovered now. So 20 you have recovered, so the net becomes 80. So this will be the net NPA. That is the difference between gross and net NPA. So in this calculation, net will always be lower than gross. Because it can't be higher than that. It can be the same or lower, because even if you get something back, you deduct that, that becomes a net NPA. So gross NPA should be less than or equal to 3%, net NPA should be less than or equal to 1%. Just to put things into context, right now the average NPA in India is at the lowest point in the last 12 years. I told this earlier. But in terms of numbers, how much is it? The net NPA in India, the gross NPA rather, in India is 2.6%. For all the banks, I am giving an average for all the banks, that is where India is right now, gross NPA is 2.6%. So RBI is not asking the banks to have a record which is very different from the average. If you are just near the average, you are good enough. So they are not asking you something out of the world, because the average is 2.6%. So if you are in the ballpark, in the same vicinity, you would be able to get that. Apart from that, RBI also puts these eligibility criteria. That is, the stock must be listed on recognized, or share must be listed on the recognized stock exchange. So the bank cannot be just a bank that is owned by the promoters. It has to be on the stock exchange. So people should be freely able to buy the shares and all. Promoter requirement, we discussed. Promoter means the person who owns it, person who started this. Promoter, no new promoter should be added or changed during the transition. So transition means when you are a small finance bank, you are transitioning to a universal bank. In between that transition, whatever time is taken, in that time period, you cannot add or remove a promoter. No changes will be allowed to promoter shareholder dilution plan previously approved by the RBI. So in most of the cases, RBI approves a promoter dilution plan. Now, what is a promoter dilution plan? Let's say I started the bank, I put in all my money and the bank started. RBI has some restrictions that for the first few years, I can't take my money back. For the first few years, I can't change the ownership of the bank because the RBI gave the license looking at me, looked at my track record. On my basis, the license was given. So I can't change the promoter. So I will discuss a plan with the RBI that, okay, not today, but after let's say 7 years, I will start to sell this, I will bring in more promoters, I'll bring in more money. So RBI approves this plan in advance. So there is an advance share promoter dilution plan that in advance we decided after these many years the promoter will start to dilute its ownership. So whatever plan has decided earlier, the RBI has decided for the small finance bank, whatever dilution plan decided, you can't change that, that will remain the same. Any small finance bank with a diversified loan portfolio will be given the preference. Diversified portfolio means if you are a bank, for example, most of whose loan is given to one big industrialist, or most of your loan is only given to industries, you don't give loan to agriculture, you don't give loan to education, you don't give loan for social infrastructure, then you are not diversified. Diversified loan portfolio means you are giving out loan in different areas, in different sectors with different profiles, so that if one sector goes down, even then your capital is safe. The problem is when the banks give a huge part of their loan to one specific company or one specific sector. The problem is if something wrong happens to that company or if something wrong happens to that particular sector, your most of the loan outstanding on the loan will go bad, the bank will suffer. So it has to be a diversified loan portfolio. That is what the RBI will give preference to. Now, we have been talking about small finance banks. I told you yesterday also we will discuss about small finance banks. Small finance banks and payment banks came up around the same time. Both of them were based on the recommendation of the Nachiket More committee. Remember, we discussed that as well. Payment banks are slightly different. They can't give out loans. Small finance banks can give out loan, but there are still restrictions on them. So they came up after the budget in 2014-15. They are registered under Companies Act 2013 as a public limited company, and they are governed by Banking Regulation Act. The minimum capital required is 200 crore. If you remember, the minimum capital requirement for payment bank was 100 crore. For small finance bank, it is 200 crore. There can be some exceptions for certain small finance banks on a case-to-case basis. Also, 75% of their loans have to be in priority sector lending. We discussed this in the last topic as well. The priority sector lending norms are different for different banks. Small finance banks, 75% of their loans, so 3/4 of their credit that they have given is tied up in priority sector lending. Usually the banks do not like it. See, the banks, it's not that the banks will not get the money back from priority sector areas. They will get the money back, they will get the interest also. But the idea of a lot of your capitals in essentially being tied to certain sectors is not the idea that the banks support. They want freedom to decide whoever they want to give the loan to. On that note, let's see if we can answer a few questions. Read this carefully. Read this, make up your mind and decide what the answer should be. Take your time, it's a long question. If you need more time, you can pause on this screen maybe, think about it, let's discuss. With reference to universal banks in India, consider the following statements. Number one, universal banks are licensed under Banking Regulation Act of 1949 and can offer a full range of banking services including lending, deposit taking without restrictions on sectoral focus. Yes, we did discuss this. That is the idea of universal banks. The common big banks that you see around you, those are universal banks. The idea is there is no restriction. that you can only take this much money, or you cannot give loan, or you can give loan in certain areas only. There's no restriction as that. Yes, there will obviously be priority sector lending and all, but apart from that, there is no other restriction that is imposed on the working of the bank as such. They are not restricted from offering any of the services that a common bank would be able to offer. Second, the concept of universal banks was recommended by Narasimhan Committee to consolidate banking operations and enhance global competitiveness. Yes, the Narasimhan Committee 2 was the one that suggested that the banks, universal banks, these kind of banks basically should be allowed, so that there is no restriction as such, and they can compete with the global banks. So the big banks globally, like Bank of China, BNP Paribas, they don't have any of the restrictions. So banks in India also should be let free, so that they can earn profit and they can be competitive. Small finance banks and payment banks are classified as universal banks due to their ability to accept deposit and provide digital banking services. No, 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 no. We discussed this. Small finance bank, payment banks are under the category of what you call as differentiated banks. That is why this is wrong. As per RBI's financial stability report, universal banks account for 80% of total assets of scheduled commercial banks. That is correct. So most of the money of scheduled commercial banks actually is held by the universal banks. They are the ones who, because again they don't have any restriction, they can accept deposits, they can give out loans of without much limit. So they are the ones who obviously have most of the assets of the commercial banks that we have in India. So 1, 2 and 4 would be correct. A would be the correct answer here. Okay, A would be the correct answer here. I hope you got this one right. If you want to take a screenshot of the explanation, do that. You can revise later on. Moving on. One more practice question for you. Let's see if you can answer this. Read it carefully and make up your mind what should be the answer to this. Think about the answer, read all the 4 statements carefully. Alright, if you want more time, you can pause on this screen, think about what the answer should be, and then once you have made up your mind, then you can play again. Alright, consider the following statements regarding universal banks and their role in India's financial ecosystem. Number 1. Universal banks are required to maintain a capital to risk weighted asset ratio of 11.5% under Basel III norms, higher than the small finance banks. Now, the Basel III norms specifically tell about how much money, how much capital you should have with you in proportion to how much loans you have given out. So, in proportion to the loans that you have given out, a considerable amount of capital, depending on how risky the loans are, 11.5% of that, for example, should be kept with you. The statement says that this is the limit for the universal banks. This is higher than the small finance bank, which is wrong. So the limit is for all the banks. It's not just about the universal banks that have this limit. Even the small finance banks would have this limit. So first here is wrong. There are 3 recommendations: Basel I norms, Basel II norms, Basel III norms, that mainly talk about what are the requirements for a certain bank to follow in order to be safe in their operations. Second, the RBI's on-tap licensing policy for universal banks, introduced in 2016, allows eligible entities to apply for banking licenses at any time. Yes, we did discuss this earlier. The RBI had a specific window where they would announce that we are opening up ourselves to giving you banking licenses. Now they don't have to specifically open up a window where they have to, or where they will be accepting applications. You can apply at any point of time, whenever you want. There is no specific time period. Third, universal banks have been permitted to offer bank assurance services without a prior RBI approval since 2022. Yes. So, as I said, universal banks can offer all the services, including providing insurance. So, insurance given by bank is the bank insurance. So, they can provide this as well. And they don't need a separate RBI approval for that. So, RBI approval is not required. They can be done with themselves. The Economic Survey 24-25 credits the universal banks with achieving a 25% increase in credit penetration in rural areas since 2020. That is actually wrong. As I said earlier, the Economic Survey has not given out these exact numbers. They have said that yes, these kind of banks do open more opportunities for credit flow in the rural areas, but they have not said that this has led to specifically this much percentage of increase or this much percentage of penetration. That part here is wrong. Thus, because you had to tell which of these is not correct, so first and fourth are not correct here. The answer here would be A. Again, be very, very, very careful about whether the question is asking you which of these is correct or which of these is incorrect. Okay, so they're asking you which of these is incorrect. The answer here would be A. 1 and 4 here are incorrect. If you want, you can take a screenshot. It will be helpful for your revision later on. I have a related previous year question here for you. It was asked in 2019. The chairman of public sector banks are selected by Banks Board Bureau, Reserve Bank of India, Union Ministry of Finance, or management of concerned bank. Now, it was in the news because the government of India started this system not many years ago. They would ensure accountability of the banks by making it much more independent. They have appointed a Bank Board Bureau. So, Bank Board Bureau, this is the body that will look into appointment of banking officials at higher levels. Not just the chairman, but the MD, the CEO, directors, etc. of the banks shall be appointed by the Banks Board Bureau. So, A is the correct answer here. RBI, Government of India does not interfere. It is the Banks Board Bureau that will make the appointments. Again, to ensure that there is as little interference in the working of the banks as possible from the side of the government or from the side of the RBI. This happens, or this process continued even today. Got it? All right then, let's move to the next topic. The next topic that we have here, again related to banking, related to RBI specifically, something that the Government of India really loves, that is the RBI surplus transfer. Now, what exactly is this? This is a huge source of income for the Government of India. See, ultimately, RBI is an independent body, it is an autonomous body, but the RBI is owned by the government at the end of the day. It is a government body. For example, whoever is the RBI governor is decided by the government only. Increasingly, the government would obviously want people who align with their thinking, who align with their ideas. They will be the one who will be sent over to the RBI. Now, one way in which the government takes a lot of help from the RBI is from RBI surplus transfer. Now, what exactly do you mean by this? As a central bank, RBI earns a huge amount of money. For example, you know RBI gives out loans to the bank and the banks have to pay an interest to them in the form of repo rate, in the form of bank rate, in the form of marginal standing facility. In all of these cases, the RBI will earn some money. Not just this, you also see that the RBI, for example, when they buy government security, the government security that the RBI gets, they earn an interest on that. So that also is their earning. Not just this, the forex reserves that they hold, the forex reserves that they have, they might invest it somewhere, they also earn income. So in short, there are multiple sources of income that the RBI has. Now, what do they do with that income? RBI obviously has its own expenditure. There's a staff that they have to maintain, the salaries, the pensions that they have. There's infrastructure that they have to maintain. After all the expenses that they have done and keeping a bit of money aside for short-term emergency purposes, they are still left with a huge amount of money. that money is transferred to the government every single year on a year-to-year basis. The income that RBI has minus the expenditure minus some of the amount that they can keep for emergency situations, the remaining money is transferred to the government of India. This is called the surplus transfer from the RBI. So the RBI, whatever surplus they have, that is transferred to the government. The government obviously likes it because it's not a small amount. Last year, the RBI transfer, the surplus transfer was the highest ever. It was 2.22 lakh crore rupees. So it's a huge amount of money. There's a big debate about how much money should the RBI keep with itself for emergency purposes. There's a debate about how much money would the RBI require if something wrong happens. See, from the side of the government, they would obviously want as much money to come in from the RBI, because who would not want that? But then the people in the RBI or people who are outside the government would also want that some money should be with the RBI. Now, how exactly does it happen? This is also not random. This is based on something called economic capital framework. Economic capital framework was given or was decided on the basis of the Bimal Jalan committee. They gave certain recommendations. Recommendations are mainly about how much money should the RBI transfer to the government, how much money should it keep for itself, and how much should they transfer. So there is a legal basis for that. The government doesn't randomly say that you have to transfer the money. There is a law for that. So the RBI Act mandates that after making provisions for bad debt, depreciation, other expenses, remaining profit must be transferred to the central government. And the Central Board of RBI approves this transfer every single May. So every year in the month of May, so you will see next month it will be in the news once again how much money are they transferring. So every year in the month of May, the government will be asked, or the government will be given some surplus from the RBI. Now, just to put things into perspective, it is a huge amount of money. To put things into perspective here, the usual budget the government allocates for Manrega, which is a huge scheme around the country, the usual budget that they allocate for Manrega is 70,000-80,000 crore rupees. So what we are talking about, the amount that RBI is transferring to the government is almost 3 times the budget allocated for Manrega. Imagine that. So it's a huge amount of money that we are talking about, and that is why the government obviously loves this idea that in May every year they would get this much money from RBI, and it has been increasing. This is the surplus that we are talking about, whatever extra money that they are left with, because again, it's not unfair. Government at the end of the day is the owner of the RBI. Just like government entities such as, let's say, ONGC, Indian Oil, Bharat Petroleum, they are owned by the government. So whatever income they have will be owned by the government, will be transferred to the government after the expenditure. So it's fair that RBI also does it. There's nothing different in that. Just like the company pays dividends to the shareholders. So if you hold shares of a company and the company made a lot of profit this year, they might decide that a part of the profit we will divide to our shareholders. Whoever holds a share will be given some amount of money. That's very common. And similar to this, because RBI is 100% owned by the government, so government is the one that gets a dividend. Just to put this into context, see the amount of money, the trend. See the amount of money that the RBI usually transfers to the government. So this is a year-on-year thing. This is the highest ever so far. This is financial year 24. The financial year 25 has ended now. Next month in May, they will decide how much money to transfer. It has reached over 2 lakh crore for the first time. Before that, the highest was, as you can see, financial year 2018-19. That was 1,75,000 crore. Before that, there have been some low years, but this year the government has had a significant amount of payout given to it, which is something that the government would obviously appreciate. Now, as I said, the RBI earns a lot of money, but the question is how? How do they generate all this surplus? So, first, the interest income that they get mainly from securities, so government securities. So, RBI obviously owns a lot of government securities of the government of India. They also may own some government security from foreign countries, foreign entities as well. See, think about it. If RBI, for example, has $300 billion, what do they do with $300 billion? They'll have to invest it somewhere so that they can keep earning. So they can, for example, they take securities of the US government. So the US government securities that they have taken so that the money can keep earning some kind of an interest. So that interest comes in. income from foreign exchange operations, selling and buying of foreign exchange, earning from currency issuance, treasury operations when they issue the currency, all these things. And basically you just deduct the expenses of printing costs, staff salary, commission that they have to give to the banks in some way or the other, reduce all of that. The remaining money that they have, they will just keep some of that aside and the remaining would be theirs. Now, how do they determine how much money do they keep? As I said, the Bimal Jalan committee is of importance here. What they suggested was that RBI should maintain something called contingent risk buffer around 5.5 to 6.5% of the on the balance sheet. So whatever income that they had, 5.5 to 6.5% they should maintain with them, so that if something wrong happens, urgently they require some funds, they would have that. Otherwise, the remaining should be given. So this risk is primarily from retained earning, surplus income then that will be transferred. How much range should there be? How much money should the RBI keep with itself? That's again something that's debatable. See, no one dislikes money coming into their pocket. Same with the government. Why would the government mind if more money is given to them? The government would appreciate if more money comes to their pocket. So the government would not want RBI to keep a lot of money with them. That is very common. But how much money to be given, how much money not to be given has to be decided by this RBI committee. RBI board decides how much money should we need for our safety purposes, so that if something wrong happens, we are prepared for it. But again, remember the name of Bimal Jalan committee. It is the Bimal Jalan committee that decided or that gave this framework, and they decide on the basis of this contingent risk buffer what do they require, and the remaining sum is given back. Let's see if we can answer a few questions based on this. If you were able to understand this topic, read this carefully. It's a long question, read it carefully, guys. If you need more time, you can pause on this screen and read it further. Let me just start discussion. With reference to the RBI's surplus transfer to the central government, consider the following. Number one, surplus is transferred under Section 47 of RBI Act 1934 after provisions for contingent risk buffer. Exactly what we discussed. It is not that RBI transfers each and every single penny that they have. Whatever they earn, they first deduct all the expenses that they would have, salaries, pension, everything. After that also, there is a certain amount of money that they would keep with themselves. This is called as the contingent risk buffer. Means in case of an emergency, if there is a buffer that they require, risk that they might face in the future, they will reduce that as well. After that, the money that is left will be given. The entire debate from the side of the government and the RBI is how much should this buffer be. RBI obviously would want it to be slightly more so that they are sorted, they don't have to face any embarrassing situation. From the side of the government, they would not want that. They would want as much money coming in from RBI to them as possible. Second, economic capital framework recommended by Bimal Jalan committee mandated CRB. CRB is contingent risk buffer, range of 5.5% to 6.5% of the RBI's balance sheet. Exactly what we discussed. This is what this particular idea is, or this particular committee suggested, that how much to give. This should not be a random decision. 5.5 to 6.5% should be the range, depending upon what are the plans of RBI in the next year. If they plan to undertake some operation that might be risky, they should keep slightly more, but that is the range in which they should keep the buffer with them. The surplus transfer for financial year 23-24 was 2.11 lakh crore, the highest ever, primarily due to increased income from liquidity adjustment facility operations. See, the RBI transferred a record sum, that is correct, but how did they get this much money? Why is it that they did not get this money earlier, and why is it that they got so much money here? There has to be some factor, right? The biggest factor is the increase in forex reserves that RBI had. So when RBI had more forex reserve, The result was that they bought more of the government security, let's say American government securities. That significantly increased the earnings. So RBI's increased earning is from different sources. And one of the most significant one was the foreign exchange earning, or the interest that they get from foreign exchange and those securities of the government. So it is not because of this. That is wrong. Fourth, Y.H. Maligam Committee of 2013 recommended reducing RBI's surplus transfer to prioritize building contingency reserve. No, quite the opposite. In fact, the Y.H. Maligam Committee, on the contrary, said that RBI should increase its surplus transfer to the government. They said that they are giving too little money to the government, they should increase it. Now, there's something interesting that you would see here. For the longest time, the governors of the RBI, the ones who headed the RBI, were actually people from economics. Indian Economic Services officers, Indian Economic Service, as you know, is a service. So people who were economists, who had their career in economics, they were the ones who were usually appointed governors here. However, there is an interesting trend that we have seen. Since the last governor, for example, the government is now appointing IAS officer as the RBI governor, which is very, very unique. IAS officers are well regarded as administrators, but not as an economist. They are well regarded as journalists, not a specialist. So one of the reasons why the government is basically going on that path, that is having IAS officers as people running the RBI, not the economists, may be because the government thinks there's a better chance that when these people are in power, who are closer to the government, who have worked with the government all their life, there's a bigger chance that they would be ready to transfer more surplus, or government's influence in RBI will increase rather than RBI being independent. Again, on paper, RBI is an independent body, but government would want a lot of the RBI's working to be towards its own priorities. If the government, for example, wants right now that more money should flow in the market, they can't control the RBI. RBI decides whether they want to, let's say, increase or decrease the repo rate or CRR or SLR. But if the government thinks that if someone who we trust is sitting at the top post in the RBI, that will be better for us. So that is a new trend that is emerging, because government wants to influence decisions such as these, that is transfer of surplus to the government. So third and fourth are wrong here. 1 and 2 are correct. Answer here would be B. B is the correct answer here. Since 2 of these are correct, 2 of these are wrong. You can take a screenshot from here if you wish to, and you can revise later on. It will be helpful for you. Got it? All right, I have one more practice question for you from the same topic. Let's see if we can answer this. Read this carefully. All right. Consider the following statements regarding RBI's surplus transfer and its economic impact. First, surplus transfer for financial year 22-23 was 87,416 crore, reflecting a 188% increase over the previous year's transfer. I just showed you the graph of how it is increasing. If you remember, this part is correct. RBI's surplus includes earning from foreign currency assets, government securities, currency printing fees, but excludes profit from open market operations. Open market operation means when the RBI sells or buys government securities in the market. That's called OMO, or open market operation. This is wrong because it includes the profits from that as well. So open market operations, any earning that the RBI gets from there, that is also part of their profit. That is not excluded from the calculation. So second is wrong. Third, the record surplus transfer of 2.11 lakh crore in financial year 23-24 increased the contingent risk buffer to 6.5% of RBI's balance sheet. Yes. So even though they kept the risk buffer at 6.5%, even then they were able to make this huge record transfer. Imagine if they would have gotten, or if they would have kept lesser risk buffer, which is what the government wanted, they would have been able to transfer even more money to the government. Fourth, as per Economic Survey 24-25, the surplus transfer has reduced India's fiscal deficit by 0.3% of GDP annually since 2020. No. That has not happened. That would have been a great thing if that happens. Fiscal deficit, as you know, is the overall deficit in a year, difference between the government expenditure and the government earning. India, year on year, runs a fiscal deficit. There is a law called FRBM, where the government of India is trying to control fiscal deficit, but we are not in that range. The government hopes that by the end of this financial year, that is financial year 26, by the time that we end it, we should be able to reach 4.5% of GDP as fiscal deficit. But no, this has not reduced fiscal deficit by 0.3%. You have to tell which of these is not correct. So our answer would be 2 and 4 are not correct. A would be the correct answer here. A would be the correct answer, since you have to choose the incorrect ones here. You can take a screenshot from here if you wish to help you revise later on about this topic. Again, RBI related topics, working of RBI, their connection with the government, these are very, very common themes in the UPSC prelims examination. So these kind of topics are helpful, are important. Do make a note of these. I have a related previous year question here. This was asked in 2021, so not very long ago. Let's see if we can answer this question. Read it carefully. Read this carefully so that you can answer this. All right. Consider the following statements. The Governor of Reserve Bank of India is appointed by the central government. We just discussed this, that the government of India controls the governor. That is why we are seeing an interesting trend here. IAS officers coming into this position rather than Indian Economic Services officers. Certain provisions of the Constitution of India give the central government the right to issue directions to RBI in public interest. No. The Constitution of India does not talk about RBI. RBI, its powers, its provisions, regulations, everything is in the RBI Act 1934. So the Constitution of India, no, they don't give any direction to the government regards to RBI. There is an RBI Act that talks about the powers of RBI, the relation between RBI and the government, etc. The governor of the RBI draws his powers from RBI Act. Yes, as I said, everything regarding RBI, the working, the relation with the government, regulations, it is all handled by the RBI Act. So 1 and 3 are correct. C would be the answer here. Pretty simple question. This was asked in prelims 2021. I hope you got this one right as well. And if you want, feel free to take a screenshot from here. It will help you revise later on. And with that, we will have to conclude this session. I hope you learned a lot of new things today. We have 2 more sessions to go for economics. We won't have a session tomorrow. It's a Sunday. So we'll be back on Monday and Tuesday. Monday, 12 p.m. Do join us to listen to the other topics, revise them. If you're reading them for the first time, even better, you're learning something new. If you have not watched any of the earlier classes, feel free to do that from our YouTube channel. In the playlist, you'll find all these sessions. Make sure that you also keep revising and practicing questions that we have given at the end of each and every topic. Once again, if you need any information about any of the courses that we offer, feel free to check out the description of the video and click on the link where you will get all this information. Once again, I hope it has been helpful. My name is Harshmeet Singh and we are here from Narayana IAS Academy. Do hit the like and the subscribe button if you are new here. Bye-bye. I'll see you on Monday. Jai Hind.